Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Friday. Oh boy, it's December 16th. We've got only 2 weeks before the start of a brand new year. I don't know where this year has gone. It's about 8:05 in the morning. The market's going to gear up to open in about an hour and 25 minutes. And as you can see here, the Dow's down about 300 points. And although 300 points isn't anything crazy with this volatility, but when you consider that the Dow Jones fell about 800 points yesterday, and most importantly, not the fact that it broke down that much, but the fact that it broke major support area. As I said yesterday, we hit this resistance the other day, and then we broke through. And if you look at the daily chart, one of the areas that we broke through right here is this neckline right here. On the Dow, this is the 33,500 level, and I believe the 200-day moving average will be next, simply because all the other indices, which have a lot more than 30 stocks, are trading well below that level. Matter of fact, let me just make sure I got the right study here. Yeah, I do. Unfortunately, the S&P is now trading below the 200-day moving average, below the neckline that I drew. I drew this line yesterday on the S&P. I just showed it on the Dow. But this is actually from my morning's video, and I said if we break through this level, we're going lower. And we did break through this level, and now we're not just lower, we're below the 50-day moving average. So let me just expand the time period. As I predicted, we are bouncing off the 200-day moving average. I know I was a little early to the party. I was saying it around here, but I'd rather be early than be wrong. And we're now coming off, and I believe we're going to come down back to the 360 area. I'm sorry, I'm going back and forth between the Dow and the S&P, but I would just look at the chart data because the chart supports my argument better than the price numbers. But about 360 on the SPY or 3,600 on the S&P 500. The 20-year bond, the long bond, we're looking at the we're looking at the ETF. It was only up 16 ticks yesterday, and it's down already almost a full basis point. And I believe this route right here, let me just increase it, will also start cooling off because even though the Fed is going to back off, slow down, rates are still going higher. They're not going lower. And if that's the case, then bond yields are going to go higher. And bonds yields are going to go higher, but bond prices are going to go lower. So again, remember, there's an inverse correlation between bond prices and interest rate yield. I said bond yield, but I should have said interest rate yield. I'm being a little sloppy. We've got the PMI today. Yesterday's retail sales data was weak. And let me talk a little bit about what's going on in the market before we get into the nitty-gritty. I kind of already talked a little bit about the nitty-gritty. We had Adobe come out with news. It was up 4% pre-market. That's important because that's an infotech, technology stock, software stock. It's good to see some upside on those type of stocks. Didn't really have any other major news announcements from huge companies. Today, we do have Darden Restaurant, DRI, important restaurant to see, not so much for the restaurant, but to see how the sector's doing and whether it's coming up or coming down. Now, let's talk a little bit about global economy so we can get a little more insight, and then I'll take you through momentum levels. So the Dow Jones and the S&P posted the biggest daily percentage decline in weeks. That's before the Dow's down 300, 400 points this morning, as market participants fretted that the Fed's higher for longer stance on interest rates could lead to a recession. Really? You're joking. No. I didn't think that was on the table. That's the first time I'm hearing it. Really, folks? Really? After all of this? After a full year of this? I mean, come on, it's kind of priced in already. But it doesn't mean the market's ready to go higher. That's kind of what I've been trying to say the last couple of weeks. We're not there yet. We're not even close. Mr. Fed, Jerome, I'm not going to be honest with you till you reappoint me, Powell said. Recent signs of cooling inflation were not enough to convince the policymakers that inflation was on its downward trajectory to the 2% target. I agree with him. The Fed projected continued rate hikes to above 5% in 2023, higher than expected just a few months ago, stoking fears that central banks' aggressive policy will push the economy into a recession next year. Again, the same song and dance we've been hearing the first 3 quarters of this year. Data on Thursday revealed that retail data sales fell more than expected in November. I believe, don't quote me, my wife told me this, so I don't remember the number, but I think it was about 11%. Let's take a look here. We'll get a better idea. I want to know what that number is. And meanwhile, and here's the good part. Now there's a 71% chance in the bond market that we're going to go 0.25 and a 28 chance of 0.50. If the market keeps going lower, you're going to start seeing an increase in this 28, and this 28 is going to start moving towards 50, and this will start moving towards 50 as well. So right now we're favoring a 0.25, but it's going to be very hard to determine how it'll shake out. Here, retail sales, no, negative 6% for the month, but they don't have annual. I'd love to see how much we're down annually, but that's not good considering with this inflation, and even with X vehicles and X gas, we're still lower. That's not good at all. All eyes today on the PMI preliminary data. The global PMI will stand at 47 compared to 46.4. They're looking at U.S. manufacturing PMI to be at 47.7. That's coming out shortly. And U.S. service preliminary PMI, they're expecting it to be at 46.8 compared to 46.2. Nothing really crazy there. Europe, this is important. European central banks extended its hiking cycle on Thursday, increasing its interest rate by 50 basis points to 2.5% in line with expectations. Finally, we're going to start seeing money gravitate away from the US dollar and back into Europe because there's interest rates there finally. It's not negative interest rates, which is crazy. Let's continue. China closed lower after U.S. government added 22 major firms to a trade blacklist on Thursday, extending its crackdown on their semiconductor industry. That's not going to be good for tech. And Japan closed sharply lower, with industrial stocks losing the most after data showed the country's manufacturing sector shrank more than expected. And then retail in America, that sounds to me like a very, very fragmented market. Now, this is the sentiment levels on all stocks above $2. Now, I mentioned this to you last week, but I'm going to say it again. Now, not only is the 200-day underwater, which it was to begin with, but now you only have 48% of stocks trading above the 50-day moving average. So the market is officially bearish again in the long term and the short term because this is every stock above $2. Now, if we want to go closer, take a closer look at that. Oh boy, I told you this was going to happen. Remember when these numbers were really above these numbers? Are you starting to see them coming back down? Remember, this was at, I'm going to remind you, I don't forget anything. This was at 90%. It's now at 65%. Let me show you. 2 weeks ago, not a year ago, 2 weeks ago, look, right here, 93, 94. Let me go to a weekly. You'll see what I'm talking about. You got to see this. We're right on the money here. Right there, went to 90, sorry, not 90%, 92.3%, 65%. Notice we're coming down just as we expected. Let's continue this. Let's look at the Dow. The Dow was at 95th percentile, 71 now, and only 52 are trading above the 200-day moving average. If that doesn't scream vulnerability, I don't know what is. And on the S&P, 51%. The bulls are not fooling anyone. So look, S&P. Now let's look at the Dow. Remember 95%? Look at this. Look at that. Yep, 95.83, 70th percentile. We're coming down, folks, and there's no two ways about it. Also, you're going to start seeing a lot more red here, as I predicted, and you're going to start seeing, you see how you see a lot of red here? This is next. What I'm still liking is the fact that only 30% of stocks in the energy are down, but you got 70. So it's backwards. Most of these, you got a higher number here, or was higher a few days ago, than here, and that's lopsided. And again, even on the NASDAQ, look at this. You only have 39% of stocks, 46 trading above the 50, 39. Folks, this is a market that's reverting back to its bearish bias. Now, looking at individual sectors, and I hope you're not going to be surprised when I show you this. Healthcare, industrial, consumer staples, energies, and utilities. We're finally starting to get things back on track. Technology, consumer discretionary communication should be the ones to avoid. Healthcare and industrial and consumer staples is where you want to be. 100% where you want to be. Now, folks, I want to explain something important to you. You see this movement right here on the Dow? And this all has to do with algos. So I want to show you guys something interesting. This is something new and something you got to pay attention to because this has been happening a lot more. This is the 200-day moving average. Look at the Dow Jones. You see this price action? You see how it's almost at the 200-day moving average right here? Look at the SPY. You notice the SPY never really went above the 200-day moving average? This trading action right here on the Dow Jones, this is algo action trying to trick you guys, the retail traders, into thinking we're going higher. You see, the Dow only has 30 stocks. It's much easier to manipulate 30 stocks than it is to manipulate 500, 1,000, 100 stocks. So the algo traders focused on the Dow and created, listen to this. This was actually in Barron's last Saturday. I hope you read Barron's because they got some tidbits. This price action on the Dow, it going above and the S&P staying here, that's the highest divergence between the two indices since 1930. I'm not kidding you. This is I didn't do the study. This is from Barron's. I'm trusting Barron's got it right. So you never used to see divergences of that level because think about it. The S&P and the Dow, they move together. Like let's look at a 3-year chart, right? Look at the S&P, right? This is a 3-year chart of the S&P, and look at a 3-year chart of the Dow. They look almost exactly the same, almost identical, except for this little thing right here. So what you're going to start noticing with all of these algos running amok, you're going to see a lot more algos taking certain indexes temporarily out of whack with others. This isn't necessarily a bad thing. You could use this as a trading opportunity. So for example, let's say you're looking at the S&P and the S&P went 5% above. I'm making this up. Let's say the S&P went 5% above the 50-day moving average and the Dow went 15% above the 50-day moving average. There's a good chance that Dow is overdone and it'll just come right back down just like it's coming right now. And I'm guaranteeing you within the next 3 months, the Dow and the S&P will look identical again. They will be balanced together. We're seeing the same thing with the Russell. Small caps haven't been breaking out, large caps have. But with the Dow and the S&P, they're both large caps. So when you're seeing such major divergence, this right here, this is fund. This is algos, not fund, excuse me. This is algo buying, trying to sucker you into thinking there's a new bull market. Look at this. Took out the high, and what happened? Came right back down. Look at a 5-day intraday chart. We were 1,100 points positive on the Dow, and we went lower. So, folks, when you start seeing one index or one sector really out of whack with another sector that has similar assets, you should know it's algo buying or algo selling distorting you into thinking that this market is changing its tune. Like a lot of traders called me here, Roger, we're breaking out the high. We're at the highest level in months. We're above the 200-day moving average. We're going bullish. And meanwhile, I'm looking at this performance study on the S&P and I'm seeing this. Look, let me show you what I'm seeing. Right here. I'm seeing this. So when I'm seeing here and traders are telling me that the market's going to break out to new highs, I laugh because it's silly. But again, this is why we look at all of these things. But algos are really changing the structure of this market. But a good tip for you is when you see one index or one sector that's related to another really out of whack with another, that could really change things, and that can give you an opportunity to arbitrage yourself like traders did on the Dow. If you would have sold the Dow and bought the S&P, you would have seen a much better slide or just understood that move is not real. Now, folks, yesterday I recorded an incredible training session with Tom Busby. He shared his details on something he calls pre-market pulses, early morning signals that pinpoint where big money is flowing, just like I do in these morning pre-market videos. Tom, he tracks these pulses daily to create a hit list so that Wall Street is targeting stocks that could move big that day. And he gives you these ahead of schedule. He'll show you how it works. It's really dynamic. It's very, very, very cool. I think we signed up 25% of the room yesterday, and this is amazing class. Now, here's the best part. It's now possible for anyone to track these pre-market pulses, and you trade during regular market hours. So there's no monkey business, nothing squirrely, but you analyze your levels before the opening bell, just like I do, just like T-Buzz does. So if the live briefing for whatever reason, if you missed the live briefing for whatever reason, click the link below to watch the session and get all the details now. Follow the link below. And if you're watching on YouTube, follow the link in the YouTube Wealth Press channel and post comments, feedback. I want to hear from you. Bye, guys. Have a great weekend. Send me emails. Support@marketgeeks.com. I'll talk to you soon. Bye.